Sunday, March 15th, 2015. This webinar just going to look at setups coming into the week and look at the S&P 500 and just kind of survey the landscape here in this market, as we did get a pullback over the last week and are back in the red on the year. So we'll talk about that. But first things first, want to look at Tesla. I've been following this for a while, and it has been about the potential 200 breakdown that's going on right now. I know we're below 200. However, in my view, you still haven't seen a real good flush lower on Tesla. You haven't had one of those fat candles where it just breaks down, you know, something like this number 1, or this one number 2, this one number 3, this one number 4, number 5 there. You know, you've still been missing that big fat candle that really knocks this thing down and makes for a great intraday trading opportunity. So the play on Tesla has been kind of selling calls and shorting call premium, as yes, you've gone down, but basically you are where you were 4 weeks ago at the middle of February. You are where you were 6-7 weeks ago in the middle of January, and you are about where you were in the middle of December. You just don't have a whole lot of net movement, even as you have made another attempt below 200 here. So bottom line, while below 200, she will remain vulnerable, but until we get one of those real hard downside days, there hasn't been a great intraday setup on Tesla. You've had to pick your spots. So just keep that in mind moving forward. Nice simple trade setup from here, as we've got key support at 185. That is the year-to-date low so far. And as for your resistance, you need to get back above 200. 200 key resistance now. If you can get back above it, then we'll be looking for tests on this downtrend line here. This is a downtrend line off of the all-time high from back in September, and you can see it has capped the stock numerous times, and that downtrend line by the end of the week will be around 207, and by the end of the month we'll be getting down closer to 200. So something's got to give here on Tesla sooner or later. If you go below 185, your next key low is the 52-week low at 177. That's from May 2014. So bottom line, Tesla's weak. However, she hasn't yet given a real hard dump to the downside. So we'll see what she's got in store for us this week. It'll be an over-under 190 setup, where the over is looking for that bounce back up towards 200, and the under is going to be looking for that flush potential move. All right, looking at Netflix. Netflix got hit pretty hard as the market pulled back. You know, she had come up towards the all-time high in the 480s and had been holding 470, but once you lost 470, that really triggered a pretty good pullback, and we came down into the 440s, breaking down below 450. And also then when we tried to bounce, which we did bounce out of this key support area in the 30s, you bounced back up towards 450, but you got rejected. That was on Thursday's move. Thursday's high was about 452. You ended up closing about 448, and then Friday you got dumped, closed back below 440 in the 430s. So Netflix trying to keep some pressure on itself here, and I want to go out to a weekly chart to show that she continues to be in a longer term channel. You can see all of 2014 to up until the beginning of this year when she made that hard gap up on earnings, you can see Netflix has been channeling between 300 and about 450. You've had some moves above 450 in the middle of last year, and then most recently on the recovery that we saw that we just pulled back off of that I just mentioned. So, now you've kind of, again, got up to the top end of the channel, but then made a hard move back down. And it's interesting because if we keep going down, from a weekly perspective, there's a lot more downside that Netflix could do without really breaking any key long-term supports. I mean, your long-term supports, in my view, are these channel lows around 300 to 350. I know it's a wide range, but that's just the way it's been. Those have been your lows since about October 2013. You had 1, 2, and then 3. You can see that's been the channel lows, and our channel highs, as mentioned, have been up on that 450. So the story on Netflix for me is, can you avoid coming all the way back down, closer to 400 and then going down towards 350? If you can avoid that, and if you could put in some support right around here, for instance, and get a higher low, then Netflix could be really set up nicely to challenge this channel resistance and show the market that, hey, yeah, I've been in this long-term channel over the last year and a half, but this time I'm not going back down to the lower end of the channel. I'm establishing myself up near the top end, staying within the top end range, and I'm going to go for a breakout. And if that is to happen, what Netflix needs to do is it needs to regain 450. Needs to regain 450, get stability back above 450. If that can happen, that's a very good sign for Netflix. But if it can't regain 450, then Netflix looks vulnerable, and another leg lower, I would expect another leg lower on a break beneath the 430 to 435 area. That is the lows right here. Okay, so if you break 430 to 435, then to me Netflix looks pretty good to go down towards 400. So very important that it gets back above 450 if you want to see a long trade materialize. Very important that you get a further breakdown below 430 if you want to see the short side that's played out off of this recent high in the 480s, if you want to see that continue to be a downside trade. All right, looking at Amazon. Amazon to me is looking kind of decent. Yes, it's pulled back. However, she's trying to hold the 370s. Unlike Netflix, which broke 470 and went right into the 450s and now is in the 430s, and unlike Google, which lost 570 and now is back in the 550s, Amazon is desperately trying to hang on to these 370s here. So if you can do that by Amazon, then I like the potential to kind of separate itself to the upside regardless of what's going on in the market. If the market's pulling back but Amazon's still holding this 370 area, then I think you have a good setup to bounce back towards 380 and ultimately trend back towards $400, which is near the all-time high. If you commit below 370, the pressure is on these lows from this week, and I believe it's right around 366. I just call it 365. If you get a 365 breakdown, that is what to me breaks Amazon further and kind of comes back down into this earnings day range where there's a lot of volume, a lot of price action. From that gap up, that was between 360 and 340. I know it's a wide range, but that is what I would target if you find the stock moving back down there. That is back below 365, I mean. So key support on Amazon 365, but I give it the benefit of the doubt if it is able to hold the 370 area. She'd be looking pretty good. Running down the list. Looking at Google, so Google, poor Google. Google looked great, you know, a week ago, 2 weeks ago. You know, this is what we had on Google. We had a awesome 550 breakout. Stock was up around 580 and kind of going sideways into 570s. You had a little pullback, but then this week drop into the 560s, then you dropped into the 550s, then you tried to hold 60, and then boom, Friday dropped back down, closed on the lows for the week, and you are back testing the breakout area. Now, not the end of the world. You know, if you can hold 550, then I like Google for a bounce here, as that previous resistance will still as the previous resistance will have still shown that it has become new support. But personally for me, I don't like the fact that Google was even able to get back down into the 550s, because it's just given up 100% of the breakout move. And to me, what that means is Google is kind of a sell the breakout candidate, meaning that if you do bounce back or you get back up near 580s, given that she was able to give up 100% of the move, and I felt like, all right, now she's finally going to start ripping to the upside, I'll be thinking about selling some calls on Google, as she just doesn't seem to have that oomph, you know, that real major momentum. We got multiple month highs, but now we're right back down, where just compared to the other names in my list, you know, Netflix, yeah, she's pulled back, but she's still, you know, holding up okay and holding on to a big earnings move. Amazon, same thing, talked about her strength, but Google, not so much. So all about 550 right here, right now. I think if you hold 550, you can bounce back, but not a huge enthusiast for Google based on the way she came back down. If you break below 550, if you're not able to hold it, then things get very interesting, and the level to watch, in my view, would be the 2014 close, right around $530. That is where you closed last year. So if you break 550, I'm looking for a back test on the break-even line, year-to-date basis, which is around 530s, and then it would just be all about the break-even line on Google. So I like the 550 setup because I think it's pretty simple. If you hold it, you're going to bounce. If you lose it, you're trending lower. But overall, don't like Google's momentum continuation prospects per se, given that she has come all the way back down to where she just was a few weeks ago. Looking at Priceline here, so Priceline has started to fill its earnings gap, was trying to hold 1200, and similar to Google, she had a nice breakout apparently, but then came all the way back down, and that was a red flag that she was giving up the move. Nice gap and break above 1200, and then you came back to 1200. You can see this week lost 1200 early in the week, tried to stay around it or within striking distance of it, but by the time Wednesday rolled around, she had another leg down, consolidated Thursday, and then a nice crack on Friday to the downside, and she has pulled back rather significantly and has almost completed its gap fill, another 25 points or so. This was the earnings day gap, but so Priceline, she's been trending lower, and right here right now 1150, yeah, I could see a bounce off of that, but I like this pullback Priceline made. Seems like the damage was kind of done, and I think Priceline is a short on bounces now, as long as she stays below this earnings day low in the 1190 to 1200 area. 1190 to 1200 is key resistance. If Priceline wants to get going again to the upside and have my trust, she needs to get stability back above 1200 bucks. All about 1200 bucks, more intermediate to longer term. Get back above 1200 and I become a big believer in Priceline to the upside again. But until that happens, I wouldn't be surprised if you see this thing kind of continue to downtrend lower, and maybe, depending on what the market's doing, come all the way back towards 1100 to 1000 bucks. Only going to mention Twitter briefly, and that's because Twitter is still in its earnings day range from February 6th. It's been a month now that the stock hasn't gotten out of its earnings day range. So pretty boring action right now. It's been making up-down movement on a day-to-day basis, but week to week and over the last 30 days, you look at it, the stock has not moved. It's at the exact same price that it was at after hours when it reported earnings on February 6th, or pre-market I should say rather. After hours it was like 44, then the next morning it got up to 45s, 46s. So anyways, until you get a break out of this earnings day range with some real commitment, then I'm just not that interested in the momentum trade on Twitter, because I don't think you get momentum until you get out of that range. Nice and simple. Looking at Apple. Apple to me is one of the reasons the market has been in trouble. You look at Apple, she peaked in late February and started pulling back, and the market then peaked in late February and has started pulling back as well. You had the iWatch release this week. You had a whippy session closing around 27s on Monday, but then you gave a nice leg down on Tuesday and Wednesday before going sideways to end the week. Apple to me got to get back above 125. If you get back above 125 on Apple, and that's this blue line right here, which I've now highlighted pink, if you get back above 125, then Apple is going back to the upside, and I think the market is going back to the upside. But if you cannot hold 125, then the risk on Apple is to the downside, and she can continue to trend lower, where these highs from late November and then late January, early February, 1 and 2, these were right between 115 and 120. That's the next downside target on Apple if you're not able to regain 125. Really think Apple is going to be a good tell for the market. If you see Apple regaining 125, I expect the market to find itself on solid footing. But until then, until Apple is above 125, I think you're going to see, the NASDAQ, which has been a leader, I think you're going to see it kind of struggle to regain its footing and start rallying again. Any questions on the individual stocks here before moving on to the S&P 500? And then I have one general question to answer as well. Okay, so the S&P did pull back this week. We lost 2100, lost that round level, and once that happened, we were able to get some channel downside. The channel downside was better than I thought it would be, quite frankly. I thought the bulls would put up a better fight. They did not. The bears did a good job. And now we are back below 2058 on the S&P. 2058 is very important to me because that is where we closed in 2014. And about 3 weeks ago, when we were still below 2058, we went back and we looked at how the S&P was capped by its break-even line last year and how long that consolidation lasted. So I'm just going to refresh your guys' memories about that. So just going to plot a trend line here at the 2013 close, and you can see that from January 1st until about the middle of April, you just had an awful time figuring out if this thing wanted to go green on the year, stay red on the year, or what. You started the year out with the February pullback and then a bounce, January pullback and then a bounce, much like this year started. And then you kind of, end of February, you rallied above the break-even line, went into the green, but then you came back down and tested it, bounced off of it, got really choppy, dipped below it into the red for a little bit, bounced back above it. I mean, you can't make this stuff up. It was a brutal, March through the middle of May for the S&P 500, just in terms of how much choppy zigzag action there was. But overall, this volatility, I remember there was a lot of fear at this time. People were really freaking out, and a lot of headlines. I don't remember exactly what the headline was, but bottom line, now here we are again, and the setup is pretty much identical so far this year. I'm just gonna again put a trend line at the 2014 close now. Let's see where we're at with it. Okay, so it's right here. So you can see, so the top blue line, this one here, this is the 2014 close. And you can see again, the year started out with a January pullback, and then you came up back to the break-even line, you stayed red, came back down, back test break-even again, stayed red, came back down, and then February you got to move up, went into the green, but now you've come back down and you're slightly in the red, little bounce, and what happens here? I don't know. But what I do know is I'm not freaking out, because we saw this last year, and the market didn't go to bed or anything like that. It just was a period of choppy action. Yeah, it was kind of frustrating because you want the market to make up its mind, but the market works on its own time. She's not going to do something just because we want it to happen. So bottom line, just be open-minded to a lot more of this zigzag type stuff around the break-even line, and until we can take out these lows, the year-to-date lows around 2000, or until we can get back up and take out the year-to-date highs, which are now around 2100, it's very possible that we see a lot more zigzag, choppy action on either side of the break-even line. If you want to trade this, I think what you do is, it's simple. If the market stays green on the year, if you can come back above 2058, get back above this channel support line, this top blue line, then I think you get a bounce and test back up towards the highs. We make one of those zags higher, at which point then you might zig lower. Okay, but if you don't go green on the year and you're staying in the red and getting commitment, below this blue line, then I think we make one of those zags lower, down towards 2000, down towards these channel lows, at which point we then might try and zig our way back higher. So bottom line, I guess, is there's a lot of chop right now, and unfortunately the outlook doesn't look a whole lot better for the chop to resolve itself, since we're so tightly around this break-even line. If last year is a guide, then maybe in May this month of March and then the month of April. Once we get through that, maybe then we'll have a much clearer picture on what the rest of the year is going to look like. But until we really get commitment away from this trend line and out of this channel, I'm not very optimistic for a big-time move, big-time trend move in the market. I should say trend move, because big-time move, I mean, we could rip 50 points back to the upside, we could drop 50 points back to the downside. Those would be big moves, but it wouldn't be a trend move because, you know, we'd still just be in that channel. Okay, so question I got asked is in regards to something I tweeted this week, and that was that I try not to predict moves. The question is, if I'm not predicting moves, how then is it possible to have a winning trade? I think this, you know, this can get taken out of context a little bit, so I'll try and put some context around it. I understand the difference between a prediction and an expectation. Okay, and I think that's where people, the person asking this question, you know, you see me say, oh, I don't predict anything, you might get thrown off and say, well, how is that possible? It's because I like to think that I'm not trying to predict anything. I'm trying to come up with expectations. And to me, the difference is a prediction is something you believe will happen. Just that's, you believe it's going to happen, kind of. An expectation is something you believe will happen if. You believe this will happen if something else happens. So to me, you know, when I go into this week, for instance, I'm not predicting Tesla's going to sell off. I'm not predicting Apple's going to regain 125. I'm not predicting Google's going to hold 550. But what I'm prepared to do is that if the market opens up tomorrow and I see Apple making a strong move back up towards 125, I'm then prepared to have an expectation that, okay, hey, it looks like Apple's going to regain 125, where then my expectation is for a bounce, and it's also for a market bounce. So if those things don't start happening, then say Apple regains 125 but it's not going higher, and my expectation isn't being fulfilled, then I will look to make an adjustment off of that. Or something like Google, you know, if Google holds 550 and I expect it to bounce back up towards 560s, but it doesn't, it only gets up towards 555s, then maybe I'll change my expectation. I'll say, hey, even though this thing is above 550, it's not bouncing as much as I expected it to off of that, and to me that's a sign of underlying weakness, so I'm going to short it and I'm going to look for a move back below 550. So, you know, what I do when I wake up and look at my prices and see what's going on is I say, okay, Tesla's gapping down 1%. What does that tell me? It tells me it's gapping down 1%. It tells me the stock's weak pre-market, which would then create an initial expectation that it has a chance of being weak on the open. And so then I'd look to see if there is that weakness, and if there is, then my expectation is going to be that it continues to go lower. But if the weakness gets bought up, my expectation is going to be that, hey, she's going to be able to bounce back up and go green. Versus a prediction where if I wake up and I see Tesla gapping down 1%, and then in my head I start saying, okay, Tesla's going down 5% today. It has to. You know, otherwise it wouldn't be gapping down 1%. And then so at the open, no matter what Tesla does, I just buy puts because, you know, I'm predicting it's going down and I'm not really creating expectations based on price action. So, you know, for me, I think predictions can be a double-edged sword. On the one case, if your prediction starts to play out, you can execute well, and it's kind of, you just need to do everything you envision it doing. But if you've predicted something and the stock isn't in line with that prediction, you can become very narrow-sighted and end up just fighting a trend or missing a completely different move that you don't see because you were only looking for one thing that was based on your prediction. So I just try to avoid predictions. I do realize in my business people want to know what I think, which is why I do stuff like this, but I'd like to think I do a better job than most of setting up two sides of the trade, or even three sides of the trade, a neutral side, versus just coming into this week and telling you guys, all right guys, Tesla's below 200, so she's going to sell off, we just need to wait, or Netflix, guys, she's looks pretty bad, she's going lower no matter what, she's a short. No. All right, try and have my parameters and my expectations based on those parameters, so I know how I want to act in reaction to what the stock itself is doing. Any other questions, guys? That's all I got here. Alright, well thanks guys. If you think of anything, email me, Kevin at Watchhimtrade.com, or team at Watchhimtrade.com, and me and a couple other people will see it. Other than that, I will see you guys tomorrow morning. Let's have a good week and see what we get. Thanks guys.